On the morning of June 4th, a couple in Ann Arbor, Michigan closed on a house. The loan was a conforming Fannie Mae mortgage from Better Home and Finance, and the down payment came from a place no Fannie Mae mortgage in U.S. history had sourced one before. Joe and Amy didn't bring cash. They didn't liquidate a brokerage account or pull money out of a retirement plan. They pledged some Bitcoin instead. The Bitcoin stayed in custody and the loan funded. So, a holder of Bitcoin can now buy a federally conforming home in the United States without selling a single coin. That's a small thing on the surface, but a much bigger one underneath. To see why this matters, it helps to understand how a mortgage actually gets approved in the United States. When someone applies for a home loan, the lender looks at three things. First is income, to see whether the borrower can cover the monthly payment. Second is credit history, to see whether past loans have been paid back. And third is reserves, which is the leg this story turns on. Reserves are the savings set aside beyond the down payment, the money that would still be there if something went wrong. The mortgage industry doesn't count just any savings, though. It has a list, written down in the underwriting manuals at Fannie Mae and Freddie Mac, the two federally backed companies that buy most U.S. mortgages from local banks. The list is where the rules of the game live, and the list until last summer was tightly drawn. Cash and checking and savings, money in stocks and bonds and mutual funds, the vested portion of a retirement account, the cash value of a life insurance policy, all of those count. Bitcoin, until last summer, didn't. To use Bitcoin toward a mortgage, the borrower had to sell it first and convert it to dollars. The dollars then had to season on a bank statement before the loan would close. And by the time the loan funded, the Bitcoin was gone. That changed when the Federal Housing Agency, the regulator that oversees Fannie Mae and Freddie Mac, issued a written order in late June of last year. The order told both companies to begin treating cryptocurrency holdings in U.S. regulated exchanges as eligible reserve assets in mortgage underwriting without requiring a sale first. The directive came from the FHFA's director, Bill Pulte. It took roughly a year to work its way through underwriting guidelines, lender pilots, and regulatory review. The first loan funded under the new framework closed on Wednesday of last week. The structure is two loans that close on the same day. The first is a regular Fannie Mae conforming mortgage, identical to the one any other qualified buyer would receive. The second is a smaller loan that funds the down payment, collateralized by Bitcoin pledged into a custodial account on the Coinbase exchange. The two loans carry the same interest rate, the same amortization, and the borrower writes a single combined check each month. Better's worked example is straightforward. To put down $100,000 on a house, the borrower pledges roughly $250,000 of Bitcoin. The Bitcoin sits in custody for the life of the mortgage and stays in the borrower's name. The 2.5 to 1 ratio between collateral and cash is the lender's volatility buffer, the room left in case Bitcoin's price drops during the term. If a borrower goes 60 days delinquent on a payment, Better has the right to liquidate the pledged Bitcoin to make itself whole. Joe and Amy triggered none of that. They closed, they made the down payment from the second loan, and they kept their Bitcoin. The shape of what changed last week is this. The Bitcoin holder now has the same option a stockholder has had for decades. The stockholder who wants to buy a house doesn't sell the stocks. The stockholder takes a loan against them, the stocks stay in the brokerage, and the loan funds the down payment. Banks have offered this kind of loan against tradable assets for as long as banks have existed. There's even a name for it. Lombard lending, after the Italian merchant families who built the structure in the Middle Ages. What was new in the United States was that the federally backed home loan system wouldn't apply that pattern to Bitcoin. The list of acceptable collateral was old, and Bitcoin wasn't on it. But as of last week, it is. For someone who holds Bitcoin and wants to buy a house, the practical change is straightforward. The path used to run through a sale, realize the gain, pay the capital gains tax, and watch any future appreciation flow to someone else's wallet. The path now runs through a pledge. The Bitcoin stays in custody. The appreciation exposure stays, and the rate is the same conforming rate any cash buyer would pay. The mechanism itself is centuries old, going back to those Lombard merchants. What's new is the eligible collateral list, and the list is the part of the rulebook that actually changed. None of this lives at the protocol layer. The Bitcoin chain doesn't know what a mortgage is. It doesn't read FHFA directives. It doesn't track which addresses are pledged as collateral and which aren't. It doesn't have a column in its ledger for liens or cosigners or borrowers and delinquency. It writes signatures and balances, and that's the entire language. The block that was mined a few minutes ago paid out 3.125 new Bitcoin to whichever miner solved the puzzle for that block. The next block will pay the same. The block after that, the same. The supply schedule that funds these payments is the same schedule that has been running without modification since the very first block in January of 2009. None of those constants moved when the FHFA issued its order last week. None of them moved when Joe and Amy's loan funded last week. None of them will move when the next borrower closes, or the 1,000th. The chain doesn't ask whether a coin is held in custody, pledged as collateral, owned outright, or sitting in a long-forgotten wallet from 2011. It checks the signature on each spend, it writes the entry, it moves on. That's the design, not a marketing line, not a slogan, just the math. The exclusion of self-custodial wallets is the single biggest constraint on this product, and it's not an accident. The FHFA directive specifically requires that pledged Bitcoin sit on a U.S. regulated centralized exchange, which means the borrower has to give up direct custody of the coins for the life of the mortgage. For a holder who already keeps coins in cold storage with their own keys, that's a real shift, and it's the cost of accessing the federally conforming pathway. The other side of the trade is that this pathway gets the borrower the same rate as the cash buyer. That rate is several percentage points lower than what a non-conforming, self-custody respecting Bitcoin lender will quote. So it's a real choice, and the choice runs in both directions. But what happens if a borrower misses payments is the next obvious question. The contract gives BETR the right, after 60 days of missed payments, to liquidate the pledged Bitcoin and bring the loan back to current. That's the lender's protection, and it's the same kind of protection any collateralized loan carries. A margin call on a stock-secured loan works the same way, just with a different asset on the line. For the borrower, the protection on the other side is that Bitcoin sitting in custody can't be touched as long as payments are made on time. The collateral isn't a hostage, and it isn't sold to fund the loan up front. It's a backstop the lender can reach for only after the borrower has stopped paying. The collateral ratio looks high at first glance, about $2.50 of Bitcoin pledged for every dollar of cash needed for the down payment, and there's a reason for that. It's volatility. Bitcoin moves more than the equity in a house. A lender writing a 30-year loan against Bitcoin needs room for the price to drop without putting the loan underwater. That extra collateral is the buffer. If Bitcoin's price drops sharply during the term, the buffer still covers the loan with margin to spare. If Bitcoin's price rises during the term, the borrower keeps the upside on the Bitcoin and pays back the loan on the original schedule. The buffer is conservative because the lender needs it to be, and it's the price of admission for the conforming rate loan. Some are pointing out that a homeowner can already borrow against equity in a house without any of this, which is true for someone who already owns a house. The product Joe and Amy used is for the buyer who doesn't own a house yet. and whose savings are mostly in Bitcoin rather than mostly in cash. The home equity loan is a tool for someone who already crossed the home ownership line. The Bitcoin pledge mortgage is the tool for someone who hasn't, and whose primary store of savings happens to be a digital bearer asset. Both can coexist. They solve different problems for different households. Bitcoin's volatility is the part that gives most people pause about this product, and the price collapse scenario is the specific shape of the worry. What if Bitcoin drops 50% during the loan term, or 70%, or some figure no one has seen yet? The first thing to say is that the buffer in the collateral ratio is built for exactly the kind of drop Bitcoin has shown before. A drop on that scale leaves the loan still covered. A drop deeper than that triggers the same kind of margin call mechanic that any collateralized lending arrangement carries. The borrower would either need to pledge more Bitcoin to top up the buffer, or accept that some of the pledged Bitcoin gets sold to bring the collateral back into range. That's a real risk, and it's not hidden in the product. It's the risk the borrower agreed to when the second loan was structured, which is the same shape of risk a margin loan funded brokerage account carries against a stock portfolio. Bitcoin's volatility is greater, the buffer is correspondingly larger, and the math is not different in kind from what banks have done with stock collateral for a long time. So that's the picture for today. A couple in Michigan closed on a Fannie Mae mortgage by pledging Bitcoin instead of selling it. The rulebook that lets them do it sits inside an FHFA directive from last June. But regardless, the block subsidy paid out 3.125 Bitcoin every block, on the same schedule the protocol has run since 2009. Thanks for stopping in for this one, and glad to have you walking through it with us. This channel will keep tracking the Bitcoin mortgage rollout, who funds the next wave of loans, and whether the rule extends to refinancing existing mortgages. If you want to keep following this thread, subscribe, hit the bell to stay in the loop. Yesterday's piece on Strategy's 32-coin sale covers the same shape of question at the corporate scale. The dividend was funded out of the Bitcoin position itself, without unwinding the position. It's linked in the description. Enjoy, and take care.